Welcome back, ladies and gentlemen. I have the pleasure today to be joined by a $1 million investor, the CEO of Wealth Research Group. We've had him on the channel before, but so welcome back, Lior Gantz. We're going to be discussing this market meltdown and how you're managing this. Last time we discussed is a bit of a different story today, and as you mentioned, it's like March 2020 all over again. But first and foremost, man, how are things going on with you?
By the time you air this, it could be a $500,000 investor. Man, it's look, this is weird because I'll tell you what's different to me. Like when you look at December 2018, the Fed raised rates, and then the market said like, this is tight enough, and Powell agreed. Like he was like, yeah, it is. Let's stop it. We don't need to tighten anymore. We agree with you. So the markets and the Fed were aligned, but this time they're hiking and they're so far apart that it's not even funny. Like the Fed just came out, a couple of days ago on Wednesday and said inflation is far too high. We have 11 million job openings and 6 million applicants. This is way out of line. There's problem here and there and this and that. But he said, look, this is not January. We got this thing under control. We're at the last innings of this being a problem. We're getting it under control, and the market starts shooting up. Then everybody goes to sleep in North America. You got like half a billion people are asleep, and the Bank of England is saying, no. Here in Europe, I know about the United States, but here in Europe, it's out of control inflation. We're going to need to raise rates aggressively. It will cause a recession, and it might even cause a recession in China, what we do here. So, yesterday I thought the circuit breakers would come on yesterday. It was really bad.
Yeah, it was rough.
So, for me, the thing, Kyle, is this is creating a solution, right? Like the Fed and other central banks are trying to solve the problem. This is not like a 2008 where, oh my God, we have a problem.
Yeah.
This is like, okay, there is a problem. We're all acknowledging that there is a problem. We're fixing the problem, but the markets just can't resolve how cheap assets should be. And I think this is because this has nothing to do with the rate hikes. I think we're at the beginning of a new era, because once you saw Facebook report earnings and go down by 30 or 40%, that told you that's the end of the FANG era. The FANGs are no longer safe havens. Then you saw Google getting hit. Obviously, Netflix. Oh, my God, look at that one. So I think we're literally at the end of that era for the FANGs, or the end of low inflation, slow growth. Therefore, if you need to raise money and grow the company, put revenues and growth first. If you have bottom line profits in 3 or 4 or 5 years from now, that's fine. Keep growing the company. This era is over. The algorithms are literally dumping and reshuffling everything. And this is what I think we're facing. We're facing a new investing era. And that's why this period is so stressful and painful, because trillions of dollars are moving from one sector to another.
Yeah.
And that has a lot of consequences for the jobs market, for how you're going to get treated as an employee. It's a big deal. Like we are in a new era.
I really feel like Apple is holding up the whole FANGs, and same with a bit of Microsoft there. But I feel like if those things start to get like that fear-driven idea where they start selling off, then it's done. But honestly, man, it's a weird market, like you're saying, right? Because we're seeing pricing power from these kind of consumer staple and discretionary companies doing phenomenal. I guess you could put Apple in that bucket. Their numbers were astounding for Q1. And like you said, there's still more jobs on the market than we can meet the demand. So the jobs market looks good. The income and savings from JP Morgan look great. Like, how do you think, like, it's so hard to wrap your head around this market, because you could run into commodities, but even, commodities are starting to cool off a bit, which could bode better for inflation. And we're watching gold and silver for the first time trade in connection with the market, which is something that has been so like a safe haven investment to get away from the volatility of the stock market. And though it's not as volatile, it's just neat to see that it is actually trading in the same momentum that the markets are doing on a day-to-day right now. I guess the real question is, man, what are you buying? How are you surviving this? I mean, you can't touch bonds right now. You can't touch real estate right now. Oil's the only thing that seems to be boding somewhat okay, but man, that feel like it's kind of getting into its glory days again. But I mean, how much higher can we honestly go with these oil prices without completely condemning the inflation rates? I mean, it's a double-edged sword we're living in, man. So what are you doing? What are you buying? How are you getting through this?
Yeah. Yeah. So I think two things to keep in mind. So if you think of the pilgrims that came to America, for example, on that ship, they need to cross the ocean. Now, could you imagine that ride? That was a treacherous ride. You got people sick. You got, you're cramping up in horrible conditions. Then there's storms, there's waves, there's everything. But you don't jump that ship because that ship is going to America. And I feel like it's the same way. Once you board the ship, once you're on the stock market, unless you get to that promised land, you cannot keep, jumping off the ship. You can fix your place in the ship, and that's fine. And a lot of people do that. But in the end, you're on that ship. So in my opinion, it's all about building more of your core positions when these freak years happen. Because if you look at a long enough trend for the U.S. markets, I mean, the U.S. is the mother of all opportunities for the past 250 years, especially at times like these when you know so much about every company that you want to own a part of. So to me, what I do is the more these markets become brutal, the more I try to trim the type of companies that I'm buying a lot of shares of, and what I try to refine it to and purify it to, I'm taking the top dog and the big dog in industries that are so high margin, thick margin, and companies that are needed in terms of B2B. And that's where my focus is. Not the consumer, which is way more cyclical, but something that's way more constant and works in a recession and this and that. Just phenomenal companies. And I can give you a few examples because I don't mind that at all. If you want the full list and more of like the breakdown and updates on it, you can definitely go to wealthresearchgroup.com to our website. There's a top menu button there that says watch lists. These are all of the stocks I'm watching and buying at certain price ranges. And then there's another one that's called Portfolio 24/7. And I think if you access that one, you'll see everything that is in my portfolio. So I think that's pretty cool. But I want to focus on a few of like the core companies that I feel like if you buy them this year, you will find them to be as cheap and attractive in 5 or 6 or 7 and 10 years from now, because these are freak years. This is a freak year. One company that I really like is called MSCI. It's Morgan Stanley, but not Morgan Stanley, the bank. This is an investment company that creates indices, just like there's a number of indices companies, but this one is well known. We all know MSCI, but the public company MSCI Inc., I mean, that company is a profit machine. And if you can find it at under $420 a share, you're getting something that is probably one of the best business models on the planet at some of the cheapest valuations it's been trading at for years and years. Look, if you can display on the screen the price chart of MSCI Inc. over the past 20 years, you will see what a phenomenal company that is. So unbelievable company. Like, you're talking about one of the best companies in the world, probably. I like them because they have their hands in so many of the financial assets that we all touch. It's almost like buying a BlackRock, but they're moving faster. They have less competition, and they find more innovative ways to make money. So that's one company that I really love right now, and I've been buying shares. I bought shares today. Nice. Another company that I really like is Roper Technologies. So if you can show that one on screen.
Yeah, for sure.
Real quick. It's a dividend behemoth. Like, my God, that company has been raising dividends consistently for over 25 years every single year. That's called a dividend aristocrat. There's only 52 companies like that in the world. And Roper Technologies, to me, and I own a lot of shares of that company, is one of the best in the world, best manufacturers of niche products in the world. I like that one a lot. Okay, do you want more?
Well, give us one more. We'll take your 3 best picks that you're buying right now.
Oh man, a third! You're putting me on the spot for a third one. I don't know if it's the best one, but it's certainly one to look at. I've been buying shares, as as early as an hour ago, and it's a company called ResMed. The ticker is RMD, and it's the number 1 company in the world in terms of products for sleep apnea. They make the CPAP.
Yeah.
And they're amazing because what they've done is they've taken that product and now they're having a dual business model with it. Not only are they selling you a product, that's fine. Selling a product is good. It's like selling a Tesla, right? But here's the beauty of it. Once you get that machine on your face in your house, they're starting to collect data on how you sleep. They've collected billions and billions of sleeping hours, and about 6% of the population has this problem.
Yeah.
They're growing insanely, but they're also selling that information to the providers, to your medical data, and that makes this entire industry work way better. So they're providing now a software as a service model, and that has way thicker margins than manufacturing a machine. They have a lot of machines. They've been growing incredibly. They're a company out of San Diego. I love that company as well. Under $200. Woo! Sell me shares all day.
Yeah,
so I love those 3, and I'll give you a doozy for a 4th one.
Yeah,
you ready?
Go ahead.
Okay. It's a company called Rollins.
Rollins.
Have you ever heard of it?
It sounds really familiar.
Okay. Well, it's a bug. And I'm not talking a computer
I think you
bug.
mentioned this one before. I think that's why I remember.
I love that one.
Yeah, I think this is one of your favorites.
It's a phenomenal company. The Rollins family owns 55% of the shares. Have you ever heard of a company, $16 billion in market cap, that one family controls 55%, the founding family? So anything that has to do with bugs, like in your house, rattlesnakes, everything, they've taken one of the few industries that are very fragmented, like mom and pop, and they've made acquisitions, and they've become an important global player in this business. And they have literally no competition, no corporate competition. And I love that. I love when you take a fragmented business. I used to own a funeral company that did the same thing. They just bought a lot of, smaller funeral homes and made it a corporate entity run by corporate management. And man, that company did amazingly well. In fact, Waste Management, the largest, publicly traded company in America in terms of
the waste management.
That's what they did. That's what they did. They took a very fragmented industry, mostly mom and pops, and they made it a corporate. So that business model has a lot of value in it if you really understand what they're doing. So yeah, Rollins under 33.
I want you
under
to,
33 a share.
Yeah, we're going to throw all those up on the screen, but you always have the most intriguing stock picks based out of it because you have a much more, I think, advanced understanding of like global economics, not being kind of controlled in the U.S. bubble. I always feel like people in the Western world here, we kind of get locked up in our own economy. So I want to pull out the crystal ball, kind of in your broad view perspective. I'm kind of going to throw you under the bus here because God knows nobody wants to make a 1-year prediction.
I'm already under the bus.
Yeah, because long term, just like you, I'm all about buying and just staying on the ship, maybe repositioning your ship to where your volatility and your investment comfort sits. But looking in the next year, man, do you think inflation gets worse? Do you think it gets better? Where do you think things end by toward the end of this year? Because I know a lot of people at the beginning of the year, especially on CNBC, thought that this was a short-term hiccup where you could just keep buying these dips and be fine. But it looks like the dip keeps dipping. So, or do you think we're heading toward a bottom? Do you think we level off here? Just any kind of short-term insight. And again, this is all speculative, so just something fun for the viewers, right?
Yeah, I think that the problem that the Fed and other central banks and governments faced is that they created this sentiment that inflation is transitory. And to be honest, it is transitory. The problem is that it's transitory for such a long period of time that it creates problems that are real and lasting. And that's called structural inflation or entrenched inflation. If we didn't have this pandemic and then the stimulus and whatnot, it would not be at 8%. We all get that logic that, or CPI wouldn't be at 8%. Obviously, inflation is way higher than 8%. We wouldn't have this problem. This problem was created because of the unprecedented times that we live in. But I don't think that we will see inflation really coming down substantially this year. It will take more time. What I do think we will see is we will see it start to flatten out. So you won't see month over month increases. You'll start seeing month over month decreases, small decreases. Inflation will still be high. CPI will still be like 7, 6, 5, big numbers, way more than the GDP growth and way more than wage growth. So definitely eating away at your purchasing power. But for the most part, we're mostly behind COVID. And if China wasn't playing games, financial warfare basically with their ports, because China when it decides anything, if they wanted those ports open, they'd be open.
Yeah.
You'd have barracks. You'd have barracks for the pork workers. They would be as sterile and as clean as a lab. And I don't mean the Wuhan lab. I mean, a Western world lab where these ports would be running 24/7 if they wanted to. They're deliberately and strategically putting more problems on the supply chains. But anyways, to answer your
day.
Huh?
That's a conversation for a different day. China's, the whole that's a broader, anyways, continue on.
I think that you have problems with Russia. To me, the central banks are not the solution here because they're not going to back down. They need to raise rates and they need to start closing down and shrinking their balance sheets. They're not going to pivot because the market is going down. I think that the solution will either come from organic buying, like literally from Wall Street saying, man, these are good prices to get back in. To me, that's the least likely scenario because the first one to go into that fire is going to be a very brave hedge fund manager. So I think that would require somebody like a Warren Buffett making another big acquisition that will tell the markets, man, this is safe. Like Warren Buffett is making big deals here. But that is less likely. I think we will have more of a realistic situation if Putin understands that if Europe is in a recession, then Russia is in a depression, and he will start to negotiate. I think that will be the most important thing that can happen to the markets to calm them down.
Yeah.
And that to me is the most likely scenario. Now, it doesn't mean that he takes all the troops out and whatnot. They'll probably stay in there for years and years. And probably always be Russian presence in the Ukraine from now on, at least in our lifetimes. But I think he will start talking about like a ceasefire, and that is going to be a big day, a big day, because Europe is really crippled right now. It's frozen.
Energy, all that stuff. Yeah.
Yes. So to me, that is important. Now, I do think, Kyle, that the markets are so forward-looking because the Fed is so clear and other central banks are so clear that I do think that financial conditions are pricing in a few months in advance already. And so you are seeing mortgage rates going up a lot. We're seeing, obviously, the wealth effect going down a lot, right? People are feeling much less secure about making, big splurges and whatnot because, they see their portfolio down 15, 20, 25%. You have to realize that most Americans, they own a lot of bonds. And the stock market is having the worst year since 1939, when Hitler invaded Poland. But Hitler was a homeless guy in the streets of Vienna when the bonds market had a worse year than this. This was 1920. So around 25 trillion of wealth in stocks and bonds have evaporated on paper from January till April. So that's a lot of money for retirees to lose. And that means that a lot of them will probably consider going back to the workforce. It means that a lot of them are not going to retire this year as they thought they would, because their nest egg has gone down by hundreds of thousands of dollars. And I think a lot of these things are getting self-corrected because of the forward looking. And then the end of COVID is obviously going to make it so that the year over year inflation numbers are going to come way more logical, right? If we were open in June of 2021, then June of 2022 will not be like a crazy situation. But because of Omicron, for example, we had year over year from January to January, it was insane. And that freaked out the markets. So I think mostly we are in a good, this is part of the solution. It's almost like a drug addict that's in withdrawal, right? His body's gonna be, so I think we are part in the solution, but it's so deceptive because the solution is very painful for what we're going through. That's one thing. I also think that the midterms in the second half of the year are going to include some pretty insane political promises, and that's going to be very good for markets. So keep that in mind. In my opinion, second half of the year, much better. But I do think we are very much like 2001, 2002, where after this bottoms, there's not going to be a V shape. This is not going back up like it came back down. This is not 2018. It's not 2020. It's not 2015. I think we're in for, after this bottoms, we're in a sideways market that slowly starts to regain confidence. It could be a year and a half, 2 years before we get back to the all-time highs.
Yeah, I appreciate those insights, Lior. You always got a fascinating perspective to offer, so I hope the viewers enjoyed it, and I want to pass the question off to the people out there. We'd love to know what you think about all of this in that comment section below. We're going to leave the link to wealthresearchgroup.com in that description box, but yeah, on that note, everyone, stay cool, stay awesome, and I look forward to catching you in the next one.